So we are doing a trade recap on a trade it took today. This was the golden US dollar, and we ended up getting a risk to reward of 5.75. So if you go to the daily, on the daily there wasn't much. Wait, let me zoom out. There wasn't much on the daily. Looks like a bullish movement, but it's a lot of consolidation here. Then if you go to the 4 hours, marked out all the highs and all the lows. This is when market opened, this blue dotted line, and then we just marked out all the highs, marked out the lows. Let me turn off this indicator. So marks it off. Yeah, it looks like a bearish movement, and then yeah, break of structure. So this is again bullish, but then it broke structure again, bearish. And so we didn't really have a bias for the day. Then if you go to the 1 hour, on the 1 hour when markets opened, price completely crashed, and we were waiting for it to also sweep this lows or to sweep these highs, even this high, and then look for a short, but it ended up only sweeping this low. We were waiting for it to sweep this low, but then we saw that it wasn't on its way and it turned back again. So how we enter usually is we look for the highs and the lows even on the 15 minute, to look for where it swept liquidity, and it did sweep big liquidity here, and we enter on the 1 minute. The way we enter is we look for a liquidity sweep, which I can show you. We had a big liquidity sweep here from these previous lows. After the liquidity sweep, we always look for a break of structure. So if you don't know what a break of structure is, let me zoom in more. To give a simple example, yeah, this didn't sweep any liquidity here, but just to use this as an example, the price went up, and when it came down, this candle closed below the previous low, and so that's basically how you know you got a break of structure. So yeah, it went down, came up, didn't break structure, came down again, and yeah, it went up, and we always wait for the candle to close. And so this candle ended up closing above this low that was created here, this bullish candle. And so we entered and got filled in about here, because just when this candle closed, price fell a few pips, and so we got filled in about here. Stop loss a few pips down because of your broker spreads. So usually, if you don't know what it is, when you put in a trade like for example on this line, let me just draw a line. If you put in a trade on this line, most of the times, depending on which broker you have, you actually get filled in at this line down here. So it depends how much it is, and it depends what day of the week and how late it is in the night, when the New York Times are open or stuff. And so when you buy, for example, and you entered at the top line, it will fill you in at the bottom line. This is just basically how brokers work, and that is most of the time to stop people from just spamming in trades and with big lot sizes and just taking them out when they are 1 pip in profit. So stop loss is down here, made space for it to price to come down and sweep these lows. It didn't end up coming down here. We barely went in a drawdown. Price went up. Our first take profit was I think it was about here. Was it here? I think first TP was here. That's a risk to reward ratio of 2.27. So when we hit the first one, we take out 50% of the lot size that we have in, and we move our stop loss to break even. So if price went and fell down after hitting this first TP, at least we took out 50% and we don't lose money because stop loss is on break even. Then our second TP was just above this candle, and then the third TP was up here. All of them ended up getting hit. This one took a while, but it went there in the end. It could have put one up here, but it wouldn't have ever even hit. Luckily we only had these 3 TPs when it came to this trade. And yes, so This was the gold USD trade that we took today. We took a few trades, but this was basically our best trade for the day. And how we can learn from this is to always be patient and to wait for the market to sweep a lot of liquidity. Sometimes you get liquidity sweeps, but small ones. For example, when this went up, it swept liquidity above these highs, and when it breaks structure, not all of the time it comes back down. In this example, it does come back down. So if you waited for this break of structure and you entered here versus short, you'd put your stop loss right above this recent high, and TP would have been down here because these were the previous lows. But we always wait for it to have a big sweep of liquidity, and we don't really want recent sweeps of liquidity. So if you make a high here and you sweep liquidity 10 minutes later, we don't always take the trades because the probability of the trade actually working out then becomes quite low. So this was basically a perfect setup. I think our entry was basically on point. We got all of our steps, liquidity was swept, we did break structure, and we had a really small stop loss. So yes, this was our trade for the day, and we made a few bucks on it. I made like 90, and some of the other people made like 400 bucks. So yeah.